The Fed might ease 25 basis points at some point, but we should not expect any type of definitive easing cycle until the stock market tells them to. And right now, it's telling them actually to tighten. But I think we're at the stage now that the market keeps pricing it in, and I just don't see why it should happen until the stock market tells them. And by going up, it's telling them we don't need easing.
Mike McGlone, senior commodity strategist of Bloomberg Intelligence, joins us now to break down Fed Day. Well, the Fed hasn't changed their rates as expected, but what is their course of action going forward? How will the markets react? And what is the outlook for not just the economy, but stocks, gold, and Bitcoin? Mike has the answer, and he's going to reveal what he believes may be the outperforming asset in 2024. Let's first hear from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of U.S. companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. Mike, welcome back.
Good to be back, David. I always enjoy talking to you.
Always enjoy talking to you as well. You're a fan favorite of the channel, so I appreciate it. Okay, so the Fed, let's talk Fed first because that's going on live as we speak. How many cuts are they projecting with the dot plots?
Well, to answer that question, I think it's still 3 cuts this year. And I think when you describe the Fed, I have to just say one word I learned from my children: meh. Just, I mean, come on, we can waste as much time as possible on this.
It's 2:03 p.m. right now. I know this is not a live broadcast, but
yeah.
There's no change in any markets. Again, this probably maybe when Jerome Powell makes a speech in 20 or 30 minutes or so, things will change. They typically do, but I don't know yet. So no surprises so far for you?
Yeah, no, not really. It's going to be what he says. I still think he was wrong back in December to pivot towards letting the market know they'll be easing very soon. And since then, we've had pretty significant speculative frenzies in equities and the stock market, upticks in inflation, upticks in crude oil, and pickup in copper recently. I mean, there you go. It's the wealth effect, ticking up inflation from intangible assets is happening. It's just a fact. And the Fed knows that. Their inflation targets are basically double the 2% target. I mean, their inflation measures core PCE and core and CPI. And the stock market's an all-time high, and it's pretty speculative frenzy. That is not an environment to be even thinking about easing. And markets are starting to figure it out. So that's what I'm concerned about is my predictions, what my job is to do, and I have the hair to prove it, is that the Fed might ease 25 basis points at some point, but we should not expect any type of definitive easing cycle until the stock market tells them to. And right now, it's telling them actually to tighten.
And what they're doing with the balance sheet is probably more indicative of overall tightening or easing, right? What are your views on the actual purchases of assets or selling of assets and how that affects markets?
Well, selling of assets is an unwind. Purchasing of assets, I hope they stop doing that. And I think in the future might realize that the excesses of liquidity that we created, we've reached the limits of learning the human lesson nature of creating too much liquidity and inflation. That to me will be the lesson to the peak of 2022. Hopefully it'll resonate forever. But forever doesn't last too long time. It's too long sometimes with politics. But that's what I think is we're just reducing that right now with quantitative tightening. To go back to quantitative easing, we'll need something pretty serious. And I think the next time we go to a recession, And I won't say if, I hope they just lower rates and keep them low rather than adding too much liquidity too fast. It's this impatience of human nature that we want to get past. I just wrote about that recently at the beginning or at the end of last year. For the end of this year, the Fed Fund futures a year ahead had priced up for 100 basis points of easing. I always look at that 1 year ahead. Right now, it's about 100 basis points of easing. And I just look at it every day that stock market goes up, those easings that market expects are trickling down. So maybe what's happening now is that high price cure that affected commodities starting about 2 years ago is trickling into the stock market. Every time it goes up, the liquidity pool, liquidity pump that expecting goes down. And I think that's the risk we face. It's kind of the potential losing game.
The S&P is currently at 5,200 points exactly. How many cuts is that level pricing in?
Right now, it's pricing 100 basis points cuts in the next year. I always look forward to 1 year, basically about
Okay.
100 basis points. Here's the facts of that. The first time in this cycle we started pricing in for 100 basis points was the beginning of last year. The Fed hiked another 100 basis points. So I guess that metric hasn't been working so well. But I think we're at the stage now that the market keeps pricing it in. And I just don't see why it should happen until the stock market tells them. And by going up, it's telling them we don't need easing.
100 basis points, is that assuming a recession? Because historically, the Fed cuts that level or that amount when the economy shrinks, does it not?
Yes, well, it's not. It right now. I think it's. I like that word. I think it's assuming shrinking inflation. Maybe the market's anticipating
Sorry,
at
my
some
my
point.
my mistake. They did that in 2019 when there was no recession, but in the past, they cut during a recession. But yes, please continue.
Yeah, but the word I think was very appropriate, and it's one of those things that it's just the market I think is sometimes can be silly, but we all know we're in a disinflation period, and in commodities, it's certainly things like natural gas, it's clearly deflation from the peak in crude oil and copper, bouncing a little bit recently, but the residue I think from the biggest liquidity pump in history is still there. And that's still showing up in a lot of these inflation metrics, a lot of them driven by insurance, owner's equipment rent, and things like that. But I think the market's not so much looking for a recession as far as pricing, it's just expecting normalization. And here's my key issue is we've been basically straight up in the stock market since it bottomed in October, up over 20% without a correction. I mean, we had 1 week was down 1.5%. That was the first week of the year. Bitcoin's had a correction, gold's had a correction. You need those corrections to flush out those speculative week longs and go back up. It's worked good for Bitcoin's worked good for gold. Stock market hasn't done the S&P 500 doesn't. To me, that's the biggest risk. And then we also have some gaps below the market in some things like S&P mini futures. But the fact on the macro is to tilt over to the biggest macro. We can go wherever you want. Is this to me is the micro of the U.S. stock market fitting into the macro of the whole world. Everything is completely reliant on that U.S. stock market to keep going up. So that's why I'm looking at for just give me one little correction and see how things react. 10%. That October correction was 10%. It put in a good low in copper. Put in a good low in Bitcoin. It kind of helped spur the gold to keep rallying. That's what we have to get past. So right now, I think this is a silly stage, and the market's just finding out that every day the stock market goes up, Fed rate hike expectations to go down. I don't know what Chairman Powell's going to say, but I hope he helps solidify that. I think his risk is he doesn't want to create volatility, but he's also creating a little bit too much speculative excess by pointing out they're going to be easing anytime soon.
Okay, so ultimately, I just want to know, or I think investors and traders alike want to know, how much it matters whether or not the Fed cuts 3 or 4 times or 5 times. Let's assume, okay, so markets are pricing in 4 cuts over the next 100 basis points of cuts over the next 12 months. Suppose they only cut by 3 times. Suppose they only cut by 2 times, right? That's a 50 basis point reduction from expectations. Does it really have a huge impact on capital markets, liquidity? Ultimately, does it really matter for the markets if they cut by only 3 times versus 4? Will we have a huge correction because expectations weren't met?
That's one thing I love about interviews with David. You've already answered your own question. It's the
Okay.
premise of it. It's true. I mean, it's kind of silly that it's not going to matter if you cut 25 or 50 a year from now. What matters is what's going to trigger that first cut, and then will we get more afterwards? Right now, there is absolutely no trigger for cutting. All-time record highs in the stock market, inflation above its targets, crude oil picking up, copper picking up recently. that's not a trigger. You need some kind of trigger, I think. And then we get to July and we're starting to get into the convention that gets political. So I don't know right now. I'm just want to get for that first bridge. Do they cut 25? And then what happens after that? My fear is they might cut at least once or twice, but I don't think there's any reason in this environment to cut more than that, to even start cutting until the stock market goes down. And that means, unfortunately, and because it's a great environment, because inflation's upticking, stock market's going up and everything, why mess with that? It's that trigger that we need. And the point is, I think it's the main thing we can't underestimate is intangible assets, the value of intangible assets, and the inflation effect, inflation demand, inflation wealth effect it's creating by going up. The stock market's going up by this much. So everybody feels good, which is great. But at some points, they're supposed to take the punch bowl away, and they're talking about adding more Everclear to the punch bowl. That's kind of silly.
I do want to get to your macro outlook in just a bit, and then we'll break it down by asset class, stocks, Bitcoin, gold, and the dollar. But I want to do a market recap before we get your outlook. What happened in the last 4 weeks, Mike? Bitcoin shot up dramatically. Ethereum, it wasn't just Bitcoin, Ethereum. Tech stocks, a lot of smaller tech stocks have been brought to my attention. They all spiked up. Meme coins exploded over the last 4 weeks. Everything just went up in tandem. The Fed didn't do anything different. The Bitcoin ETF approval was January, so that wasn't it. Well, what happened? Do you know?
Well, I do like going there because I like to point out, just like you said, so we're near the end of Q1. We've got all-time highs in gold, all-time highs in the stock market, all-time record highs in Bitcoin. Now there's been some profit taking in those. And the question, who wins at the end of the year? And I did like to publish is, gosh, I hope it's not gold, and I fearful it might be, because um, we have some other significant things in the macro that are still kicking in. I just published recently stuff that used to matter. Leading indicators are still negative, below 5%. Darn, that used to matter. Um, the yield curve is still inverted. Darn, that used to matter. Diesel demand in this country is declining. Boxes demand is declining. And then I like to tilt over to interest rates. People keep pointing out the U.S. 10-year note yield at 5.3%, 4.3% is high. Well, if you look at compared to China, Japan, Germany, they're all about 200 basis points less if you take the average. So what I did recently is you just compare the U.S. 10-year note to the top 4 other countries in the planet, which includes India and those other 3, and the U.S. is still 100 basis points above those. So what I see is happening is the rest of the world is clearly tilting towards recession. Bond markets are good indications for that. Their bond yields are going that way. China's a good indication of that. And only China started cutting rates, and they've had to cut rates partly because their economy's imploding. And I think they're just not really, we're seeing that anecdotally. And then we have the U.S. The U.S. To me, the macro is so important. The U.S. stock market keeps going up. So maybe that's part of the tilt from Mr. Powell. But just imagine an environment we have a normal 10% correction. We will have one of those. Hopefully this year. We have to see how the dust settles and when that happens. The point is, if the U.S. stock market goes down, which is say it corrects 10% and stays down, that's a deflationary dominoes kicking in based on what's happening, the recession tilt in the world. So to me, the macro is overwhelmingly dependent on that stock market going up. Yet by some measures, have I heard some people say the U.S. stock market is in the 95th percentile of the most expensive it's ever been. Now, I can give you my specifics. So to me, that's the overwhelming macro. And then I can tilt into commodities too, but I'll pause and see where you want to go.
Okay, well, we're going to get to all that, but just finishing off my question. Do you think that this rally over the last 4 months is the beginning of a renewed bull
No,
market? No.
I think it's a sucker's rally in equities, maybe a little bit high in Bitcoin because but not in gold, because I think gold, I'm fearful gold's going to take off partly because it's happening without any corrections. It's bringing everybody in, and let's look at facts. This rally in equities is upticking inflation and downticking the potential for Fed cuts. That's the high price care kicking in.
Okay. You brought up this report. I have it pulled up in front of me. Actually, risk of stuff that used to matter in 2024. You've already brought up a few indicators already. What's your thesis here? Are you suggesting that these indicators no longer work, or are you changing your view that we're going to get a recession? What's your takeaway from this research report?
Let's hope they don't work. That's the problem right now. So that's why I think this is a bit of a sucker's rally. Um, so I'm being a bit rhetorical and facetious. I think they always did, always have, and always will work. But the risk, I think, is of delayed reaction. That we finally realize that, okay, we are going to get, here's a simple way to look at this market. Last year, about this time, we're way towards tilted towards recession. We had a 20% discount from the all-time highs in S&P 500, and there was a complete consensus the Fed would hike and we'd have recessions. This year, we tilted completely the other way. Soft landing's already happened. The Fed's going to ease. Oh, and by the way, inflation's starting to uptick. Here's my view: is we're just going to swing the pendulum back a little bit. So that's why I was right. I had to remind people, partly because last week I was at the Greenwich Economic Forum and there was still so much bullishness. I had to point out, the curve is still inverted. Diesel demand is declining in this country. Paperboard box demand are declining at levels that you saw during the last recession. We have the U.S., the rest of the world having major problems. China's completely dependent on fiscal monetary stimulus, and we have the stock market. The U.S. stock market's the most expensive ever versus the rest of the world. If U.S. use the MSCI ex-U.S. index, so that's a bit dicey. And then there's simple little measures like just take the U.S. stock market versus GDP. It's the highest on a relative basis since 1930s. And okay, well, maybe that doesn't matter anymore. But my point is, let's get through this first 10% correction in S&P 500, and that will give us an indication if some of these significant indications from the past will start mattering. By the end of the year, if they don't, I'll probably put fill or kill on it. That's my point is, it's important to point this out near the end of Q1. Now, if we run into Q4 and we still have these things, the market's still ignoring those events, you'd have to be saying by then, well, yeah, okay, the world's changed. But right now I'm willing to say end of Q1, pretty speculative, excessive. I think there's simple, well, let's end with this. There's an alternative. You can get guaranteed 5% in the US T-bill for the next year.
On the chances of a recession, let me just posit a theory, and please correct me if you think I'm wrong here. I'm looking at the probability of a U.S. recession as predicted by the Treasury spread published by the New York Fed. They update this, I think, monthly, right? So it's currently at 58%. We spoke last year that's 70%. So it's come down and then went back up, but it's still hovering around just for comparison's sake, in 2007, it was 40%. This is the highest it's ever been since 1981 in terms of the Fed's certainty of a recession in the next 12 months. And in fact, every single time this probability went to 30% and right above 30%, a recession immediately follows. The only exception, I believe, was 1969 was the only exception. But anyway, you get my point. This is a pretty solid indicator. Is it possible, Mike, that we already saw? And by the way, it shot up to 70% last year. No gray bars for recessions. Is it possible we already were in a recession? It just wasn't officially designated as one. 6 months later, we'll look back and say we already lived it. Now it's time to move on.
Always possible. I do like your animated way you dug into that data. That was pretty cool. Active and to me, okay, that's already priced in. Okay, so if you're running money, the risk is that these numbers will matter, and this biggest distortion in history of COVID, of liquidity, and then of the Russia's invasion of Ukraine will matter. It's just making things a little bit more dicey, and then the normal pendulum will start swinging back down. To me, that's what's happening. The amount of wealth that was created in this country by pumping the system of the most liquidity ever is starting to decay a little bit. And then the amount that we've used, the amount of deficit spending in this country is unprecedented outside of a war or recession. So that's tilting, kicking the can down the road. What's wrong with $1.6 trillion of GDP growth that cost $2.5 trillion of deficit spending last year? So those are keeping things alive. But to me, that's where I tilt over a little bit to gold and Bitcoin as alternative assets. But we mentioned the probability of recession from the yield curve I published recently. I just look at leading indicators, and they're at -7%. They've been there a long time. They've never been below 5% without a recession, and we're still there. But to me, that's the issue is the distortions of what happened. Study your history. I've gone back and read a few books on this. It's just when you get liquidity pumps this year, you always dump. That's what's kept me bearish commodities. But the key thing to remember is it's the fickleness of human nature. When we all priced for the recession, wrong. I fully was too much in the consensus, and now we've all completely priced for a soft. We've had a soft landing. Now it's just tilt back the other way, and that's what I think is the number one driver of everything. Now, when we get that little bit of a drawdown in the S&P 500 and see how things react, and that's the problem. Every time it goes up, It takes away Fed easing. It increases inflation. It's a high price cure from commodities if tilted over to the stock market. I see it as a lose-lose, and that's why I say, but people do have an alternative. They have T-bills.
In your report, you talked about, I'll just read this paragraph. This is very interesting. The U.S. Treasury 10-year yield at about 115 basis points above the average of the next four economies, China, Japan, Germany, and India, may portend global economic headwinds. I think you alluded to this earlier. At the end of October, around 150 basis points marked the widest point of this metric in our database since 2006. And then you went on to say that what's different this time is China's growing dependence on substantial fiscal and monetary stimulus for economic buoyancy and the potential inordinate burden on the record-setting U.S. stock market to lift all boats. Why is this important? Why is it this spread? Why is this important for global economic growth?
Because when I've been pointing out, I used to use this a lot. Sometimes when I get bullish treasuries, I oftentimes like to compare U.S. treasuries to other countries. Oftentimes I'll use South Korea as one example, but I like to point out Greece is 100 basis. Greece 10-year notes are 100 basis points less than the U.S. So it's exactly people like, isn't that aren't they a serial defaulter? But I haven't been there for 30 years. I remember eating my way out of the country because drachmas were worthless, and I really enjoyed those euros back then. But the point is, bond markets are hard to lie. I mean, in China, it's no longer China. With respect to the Chinese people, its history and its future, it's one person. And one person leading a country like that cannot have, it's impossible to get proper information because if you give the person the wrong information, you're fired, you're admonished, or something happens to your family, something horrible. That's just the way life is. So I wanted to put that in that interest rates spread up. So this is what interest rates are saying about the rest of the world. It's clearly tilting towards a recession. Now we see that in Europe. Germany is in a recession. Canada's tilting. Japan's tilting. Finland's tilting. UK's tilting. And most of those countries haven't even started easing. Usually it takes a long and variable lag to central bank easing to get out of these situations. What's the significant situation in the world is China is imploding. Their economy is just doing what China, I think what Japan and the Soviet Union did 30 years ago. I just read the book, The Party, about the Chinese Communist Party by McGregor was the author's name. It read to me just like Atlas Shrugged, and that to me is the most significant thing that's happening in the world. Is that unlimited friendship between President Xi and President Putin's shifted the world order. Before we had kind of three dicey bad guys. Now we have four definitive bad guys: China, Russia, North Korea, and Iran have all kind of in the same camp because President Xi tilted there. Okay, let's move on. So to me, that's where the world's largest significant demand pull source for commodities is imploding, just reverting. I mean, who are they going to export to? Russia? Well, good luck. It's not much who they're going to buy. And so that's the deflationary factor in commodities. And then also all the things that many companies some people were able to sell to China is having big problems. We're seeing that with Apple and Volkswagen and many other things. So that to me is a tilt. And then there's this one thing that's holding thing up. It's not only the U.S. U.S. is doing great on deficit spending and the wealth effect, but it's the U.S. stock market. To me, the leading indicator for everything. So that's why I look at it is there's certain times you're supposed to just be underweight. And there's certain times I just look at it's the most risky the whole world's ever most dependent the world's ever been on the U.S. stock market and going up. Because we just have a normal 10% correction, we should see the beginning of what it looks like when the tide goes out. And it's to say we're not going to get a 10% correction this year is very rare, or very odd. You always get them. Let's just see that first. Let me get that first before get past that bridge.
Okay. Let's talk about gold and stocks now. You talked about this earlier. We'll reference this briefly. Let's talk about it in more detail. You wrote an entire report called Gold Crosses. The metal may take the 2024 medal. Let's summarize this report for the audience here. Why do you think it's possible for gold to overtake stocks by the end of the year?
Let's put the facts. First of all, the total return of, let's say, GLD, the top gold ETF versus the total return of SPY, the top S&P 500 ETF, is about 20% since the end of 2021, which right before the Fed started tightening, and S&P 500 is about 14% or so. So gold's actually beating. Now I actually picked a price in time, but a significant price in time, and that to me is the risk that gold is silly rock that you take out of the ground and put back in the ground is beating the performance of the stock market. To me, that's the big risk. In a normal recession in the US, that should happen. The difference is also gold is only like $50 from the high it made, a high above the high it made in 2020. It's just kind of hovering here versus most other markets are well above their old highs. Certainly the S&P 500. So just a little reversion. The S&P 500 typically pressures all assets, but I think it's going to be different from when it did that to gold in 2008. It dropped 30% and then went back up because gold's just waiting to go higher. And here's the key thing I like to point out is what I'm about gold is that world order shifted when with the unlimited friendship, and we all know the biggest, deepest pockets on the planet, central banks are buying gold. China's the number one suspect, and not just China's central bank, but Chinese citizens. And we're, despite, I would say, almost unprecedented ETF outflows in the US, in most ETFs, global ETFs, gold's still ticking higher. That's showing divergent strength. So here's what I think is going to happen. Let's predict the future. I fully expect central banks like China, Russia, and whatever else are going to keep buying gold. And at some point, we're going to get in ETF inflows to switch from outflows to inflows. What's that going to take, I think, is the U.S. stock market to stop going down, stop going up, meaning that it's significant competition. And right now, we still have T-bills at 5%. That's significant competition for anybody, in the Western world to not be in the U.S. stock market. So at some point, when we see that we'll probably have a decline in equities, gold I think is going to take off. And gold is just, to me, it's a matter of time it gets to 3,000. I just don't know when, and this is how it does it historically. And I'll end with this, but you just can't have gold without some Bitcoin in that space anymore in the world going digital.
This is why I like talking to you. You're reading my mind. Okay, that was my next topic, Bitcoin. You didn't put Bitcoin in this comparison. Where does Bitcoin fit in this matrix? Gold versus stocks versus Bitcoin.
Again, and there's another one, all-time highs. Here's the significance of Bitcoin is I was shocked by the amount of interest and flows in ETFs. So we're seeing significant outflows in gold ETFs and significant inflows in the new Bitcoin ETFs. Okay, there's a fact. And at the same time, you can see the diminishing supply of Bitcoin and increasing in demand and adoption on a global basis. Just this morning, I read about articles about Argentinians buying Bitcoin. So that's unstoppable. Now, the only problem, I think the main problem with Bitcoin is it has a much higher volatility in gold, essentially 3x. And that's what I think. I'm still waiting for that big test. Can it show that it does not, it has a higher beta to gold than the S&P 500 when the S&P 500 has a drawdown? Now, initially, when you have a drawdown in the S&P 500, almost all riskier assets follow beta. And here we are. I mean, everything's going up. That's wonderful. But at some point, we have to have that drawdown in the stock market. I'm just waiting for that test. And this is also as a trader talk, and I think most people are running money, hot money. I used to work at a hedge fund, are just kind of playing for that test. Give me a test. Let me see how this works out. And if you do your value at risk model, for example, what's your biggest risk to holding crude oil or copper or even some Bitcoin right now? That beta drops. And I think beta droppings might initially pressure gold, but it'll kick in that acceleration. So right now, everything's great. But it's the next trade that matters, and it all is going to be predicated on we just have a little bit of back and fill in the stock market.
How does the halving that's going to happen in a couple months factor into your analysis?
Yeah, it's to me things that are that known are not that important, but it does show the defining diminishing supply of Bitcoin that is very attractive, juxtaposed with increasing demand and jobs, and that's just a simple rules of economics. Price must go up over time.
We spoke about Bitcoin several years ago. I'm not sure if you remember this, but you told me back then you wrote a report. You said that if nothing happens to Bitcoin, it will just naturally on its own go to 100,000. This was before the correction. This was before the big rally up to new all-time highs. Standard Chartered updated their Bitcoin forecast to 150,000 by year end. What's your take?
I'll stick with that initial forecast.
Okay. If status quo, cateris paribus, nothing else happens, we're on track to $100,000. You're comfortable with that?
That I have to say thank you for being nice, but that would be too much of a cop out.
Okay.
If all these simple little conditions, to me, it's just a matter of time. It's just come on. It's defining diminishing supply, increasing demand and adoption. That's kind of like a next big target, and then there's noise in between.
Okay. Gold, stocks, Bitcoin have all reached all-time highs this year. I think investors and viewers watching this program right now have to be. We take this year for granted because it's very historical. Actually, I mean, no one's really.
Yeah.
I don't feel the excitement talking to people every day, but it is historical. Everything's at all-time highs, despite the fact that global liquidity is shrinking, despite the fact that real interest rates in the U.S. are rising, despite the fact that the Fed hasn't done anything yet. So, what is driving all these assets up to new highs? I mean, the last time this happened was 2020 when there was unlimited QE, but that's not the case. What's the tide that's rising all boats right now?
Yeah. That's where I think we're going to look back from the future. And I think as far as answering that question, I think the back from the future look will be this is kind of silly stage. And markets are playing those irrational stages. But the bottom line, I think, from a U.S. standpoint, is the exceptionalism of the U.S. is quite extreme, which is wonderful. That's part of the reason it's hard to be bearish the dollar, but it's the background of the, I would say, the repercussions of the biggest liquidity pump in history, the biggest amount of fiscal stimulus ever without a recession or a war, and the wealth effect from those key things that are still holding up markets. And then there's the human nature that I think I'm really worried about, where you get to these levels, it always makes highs where you have to perform with the market. If you don't, you're fired. And I think we're at that stage now. That's where I just look at this. Bottom line for me is that US stock market's wonderful if you can find other ways. I think what's happening with most smart money now is they're using option strategies to be part of that upside gamma and not have the risk and the downside, which is, I used to do that for a living, structure that for myself and for clients.
Very good. Appreciate your thoughts, Mike. Where can we follow your work?
So I'm on LinkedIn, Mike McGlone LinkedIn, and Bloomberg. Happy to add people to my distribution list if you ask. And on Twitter, Mike McGlone at Mike McGlone 11.
All right, we'll put those links in the description down below. Make sure to follow Mike. Thanks very much for your time. We'll speak again next time.
Thank you, David. Looking forward to it.
And thank you for watching this program. Like and subscribe.